Okay, well, thank you everybody for joining us today. We are here to talk about revenue recognition and how it is going to impact our nonprofit organizations. So by way of introduction, my name is Pam Eggert. I'm an audit partner here in our Phoenix, Arizona Eide Bailey office. Also on the line today, we have Stacy Nelson, who is an audit partner in our Sioux Falls, South Dakota office. So both Stacy and myself work in the nonprofit industry here at Eide Bailey. So learning objectives that we're going to focus on today is identifying the impact of the new accounting guidance for contributions received and made and how that impacts our nonprofit organizations. We're also going to dive into the impact of the new revenue from contracts with customer standard. So there's really two standards we'll be focusing on today, both centered around revenue recognition. And then probably the most important piece of it is how do we take this back and implement this in your own organizations to make sure that you're compliant with those standards that are affecting your organizations. So as I mentioned, we have two standards that we're talking about today. The first one is ASU 2018-08, and this is clarifying the scope and accounting guidance for contributions received and made. And then the second one we'll be talking about is ASU 2014-09, and this is revenue from contracts with customers. So a couple things to point out here. ASU 2014-09, this is a standard that crosses all industries. This just not only does it impact nonprofits, it impacts all industries. And what the FASB was really trying to do with this standard was to create better consistency among industries as far as revenue recognition goes, trying to provide a better framework and a roadmap to recognizing revenue. But the piece that was excluded from that was contributions. So in the nonprofit industry, that's a key area that we focus on. So it really left the question of whether or not there needed to be some clarity as it relates to revenue recognition centered around contributions. So that's kind of why this second standard came about, 2018-08, and really trying to create clarity, eliminate any of that diversity in practice that we sometimes see when it comes to revenue recognition in nonprofit. So today we'll be focusing on the impact of both of these standards on our nonprofit organizations. So ASU 2018-08, effective dates, again, this is for contributions received and contributions made. So we really have two sides of it. We have those that are receiving contributions, which is the recipients column. And then we have providers, who are those that are making contributions. You'll notice in the first column of each of these buckets, there's an implementation date. These are going to be for public business entities or nonprofit entities that have public conduit debt. So there's a little bit early implementation period for those. We're going to focus on the second bucket in each of these, which I think most organizations will fall into. So effective date for 2018-08 will be calendar years ending 2019 and fiscal years ending 2020. And then for those that are providers or that are making contributions, those are looking at implementation dates of calendar year 2020, fiscal years 2021. So you'll see that there's a little bit of a delayed impact between recipients and providers. And really the reason for this is the providers, it's not looking at the revenue recognition side of the transaction. Those are looking at the expense recognition side of the transaction. This standard applies to all entities, which would include business entities that receive or make contributions. One thing I want to point out as far as recommendations that we've been making to organizations is, if you're an organization that is both a recipient and a provider, it would probably make sense to implement both sides of this standard at the same time to eliminate the potential for any financial results that would be skewed, especially to the extent that you're getting, you're receiving specific grants that you turn around and you provide to others. So recommend you probably implement both sides of the transaction or both sides of the standard at the same time, so you're not skewing those financial results. And then the second standard we're talking about is ASU 2014-09. This particular standard is centered around contracts with customers and how to recognize that revenue. So towards the end of the presentation, we'll talk a little bit more in detail about this. The effective date for this standard is calendar years ending 2019 and then fiscal years 2020. So as you can see with the effective dates, both of these are very much on the horizon for us. So the first one we're going to dive into today is 2018-08, which is clarifying the scope and the accounting guidance for contributions received and contributions made. Again, today we're focusing mostly on the revenue recognition side of this standard. So really, the clarity that's being provided through this standard is centered around two issues. The first issue being, is it a contribution or is it exchange? Is it an exchange transaction? So many nonprofits today are treating government contracts or government grants as exchange transactions without really regard to the substance of the agreement or the contract, with the idea that the government doesn't give contributions. The activities are kind of viewed as, the government is giving the nonprofit the money to carry out whatever it is on the government's behalf. What this standard is doing is trying to provide better clarity into actually looking at the substance of the agreement. So really the key focus in this first issue becomes, what are the terms of the agreement? And boiling that down. So we'll kind of break this issue down further, as well as issue number 2, which is it a conditional or is it an unconditional contribution? Currently, right now, there's a little bit of gray area, especially if you have a conditional contribution as far as probability of when you're going to meet that condition, determining when you're going to recognize that revenue. Really, this standard is taking that gray area out and trying to make it a little bit more black and white. So really the key focus of this issue becomes, what is that point of entitlement? And this will really trigger the recognition of the revenue. So the first question, again, the key issue of, is it exchange or is it a contribution, really comes down to the question of, is it a reciprocal transaction or is it non-reciprocal? So the key question to ask is, who's receiving the benefit in the exchange of these goods? The standard really makes it clear that if it's the general public that's receiving that benefit, there's not a direct commensurate value between the resource provider and the recipient. So therefore, it would fall under a non-reciprocal transaction and it would follow contribution guidance. That feel good or that societal benefit where the public is getting that is not direct commensurate value. If the intent asserted by both the recipient and the resource provider is to exchange resources for goods or services that are of direct commensurate, you'll follow exchange revenue guidance or 2014-09, which we'll talk about in the second half. Some other indications here: if the recipient is soliciting the assets without the intent of exchanging goods or services, that would be a non-exchange transaction. If the resource provider has full discretion as to how much they're going to be exchanging, that would also be an indication of it being a non-exchange transaction or a contribution. But if both the recipient and the resource provider agree on that amount of assets being transferred in exchange for the goods or services, it's an exchange. So really the question becomes, who's receiving the benefit? Is there an equal exchange? If there is an equal exchange, it would fall under exchange transaction. All others would fall under a contribution guidance. So a couple real life examples to kind of put this into perspective. If a nonprofit is receiving money from the government to educate the public on dangers of texting and driving, the general public is the one that's receiving the benefit in this transaction. So there's not direct commensurate value, and that would be considered a non-exchange transaction and be considered a contribution. Another example would be that a pharmacy provides money to a nonprofit to study the effect of glucose levels. The pharmacy is the one that retains the results. So they're determining that there's an equal exchange. That would be an exchange transaction. So I am going to hand it over to Stacy, who's going to talk to us about conditional versus unconditional.
All right, well, thanks, Pam. So yes, after we've determined that we have a contribution, the second issue then, do we have a condition? And this issue would be, or this determination would need to be made by both parties, so both your resource provider and your recipient. And what does that matter, you might ask? Well, as Pam indicated initially, that is going to affect the timing of when you're recognizing the revenue. So if you have an unconditional contribution, you're going to recognize your revenue immediately. However, if you determine there is a condition, you're going to wait to recognize that revenue or expense, if you're the resource provider, as those conditions are met. So under the new guidance, in order for there to be a condition, there needs to be two items. So you need to have both a barrier that the non-for-profit must overcome and either a right of return or a right of release. So if you've received those assets in advance, you may have to return them back to the resource provider. Or if you have not yet received those, the resource provider might be released from their obligation to provide those. So many times it might be a little unclear which way it's falling, if they should be treated as a contribution with or without conditions. And if it's unclear and the documentation clearly is not indicating that it is conditional, you would determine that it's unconditional. So another thing to point out is that these two items, both your barrier and your right of return, they need to be included in your agreement or in your contract, or within a document referenced within your agreement or contract. So perhaps your actual grant agreement references other standard terms and conditions, and those standard terms and conditions include both the barrier and the right of return. It would need to be actually laid out in either of those places in order to be considered a condition. So an example of this might be many foundations contain certain standard wording in their agreements that include like the right of return or release from the obligation. So just want to caution here to watch out that just because you have maybe the release or the right of return language, you also need to have the barrier. So if there is no barrier, you would not consider that to be conditional and you would record it immediately. So as Pam indicated too, these amendments changed existing GAAP. Previously, we kind of had that assessment you would make about the possibility or the probability that those conditions would not be met. And if it was remote, you would consider that to be conditional. Under this new clarification, that probability assessment is gone. So you're going to look strictly for whether you have the barrier or the right of return. So these barriers are meant to kind of replace that probability assessment. And as a result, may result in more of your contributions being considered conditional than they were previously. All right, so what is a barrier? So there's three main indicators that a barrier exists. The first one is the inclusion of a measurable performance-related barrier or other measurable barrier. The second one is whether a stipulation is related to the purpose of the agreement. And the third one is the extent to which a stipulation limits discretion by the recipient on the conduct of an activity. So we're going to look at each of these in a little more detail. So the first one here, we have measurable performance-related barriers. So many times this will be coupled with a time limitation. For instance, the activity or the barrier needs to be completed within a year or by a certain date, for instance, July 1st of 2020. The recipient's entitlement to those transferred assets is contingent upon achievement of certain items. So there's 4 bullet points here. The first one is the specified level of service. So an example of this might be a soup kitchen where maybe they need to serve 1,000 meals per week, for example, in order to receive that grant or contribution. The second one is units of output. An example of this might be for a grant where in order to meet those grant goals, maybe the students need to obtain a minimized standard test score. Specific outcome. This, most common, we see this where you have a matching contribution. So for instance, maybe a community foundation is going to provide a $50,000 grant if the nonprofit organization can match that $50,000. Or the last bullet point here is an occurrence of an event. So for instance, say you have obtained a capital grant or a capital contribution, but it's contingent upon obtaining a building permit or some type of approval. Maybe the local authority has to approve based upon project milestones. So these would be some examples of a measurable performance-related barrier. So the next one, the second indicator we're going to look at is limited discretion by the recipient on the conduct of an activity. So these are really relating back to how the activity is being conducted. So you might think many times this is confused with a restriction. So with this limited discretion, we're really looking at how the activity is conducted. So it's more specific than a donor-imposed restriction. So your restrictions are really limiting the use of those contributions, but not necessarily how the activity is being performed. So some examples off to the right, you can see the first bullet point we have here is a requirement to follow specific guidelines about incurring qualifying expenses. So if you have your federal awards, where you need to incur costs in accordance with the cost principles under uniform guidance. That would be an example of your limited discretion on the conduct. Similarly, the requirement to hire specific individuals as part of the workforce conducting activity. So maybe your agreement lays out that you need to hire veterans in order to carry out the work of the grant. Or the third item here is specific protocol that must be adhered to. Maybe again, like if you have a construction of a building, maybe you need to meet certain energy efficient requirements. And with that, we have our first polling question. So for a donor imposed condition to exist, it must have both factors. All right, so that is correct. A, you need to have both a barrier and a right of return. All right, so moving on to our final indicator, our third indicator, stipulations that are related to the purpose of the agreement. So these are going to usually relate to how those funds are used. Some examples that are included here, it could be a requirement for the animal shelter to expand its facility to accommodate a specified number of animals. It could be the requirement for a hospital to spend those funds on Alzheimer's disease research. Or it could be a research report that's summarizing the findings from a grant on gluten-related allergies. So a stipulation, the standard or the clarification does spell out that if you have a stipulation that's unrelated to the purpose of the agreement, so those that are considered administrative or trivial in nature, those are not indicative of a barrier. So this is, a lot of times you have routine reporting, maybe it's an annual report or a progress report that you're required to submit. It could be submitting a budget. These are not considered to be barriers, and as such would not trigger you having a conditional award or a conditional contribution. So again, if we have unconditional, we're going to recognize immediately, and if we have conditional, we are going to recognize when those conditions are met. So if you have received those funds in advance, you are going to treat those funds as a liability or refundable advance until those conditions are met, and then they would be removed from that liability and recognized as revenue. A best practice would be not to label that as deferred revenue, as that may raise questions about the applicability of the exchange guidance or the other revenue recognition guidance under 2014-09. So after you determine that you have no condition, the next thing you're going to look at is to assess whether you have a restriction. So we kind of talked about the difference between those barriers and restrictions. And restrictions are limiting the use of the contribution, so what you're doing with the money. So but not necessarily whether you are entitled to the contribution. So they're a little less specific, versus conditions are more specific and are generally on how you are using that money or how you're going to conduct that activity. So with that, I will turn it back over to Pam, and she is going to walk us through a couple of examples.
Okay, thank you, Stacy. So what better than to actually look at some real life examples? So this first example that we have here is a federal award. So Feeding America is awarded a research grant from USDA to study food insecurity in rural areas throughout the nation. Some of the stipulations in the agreement requires Feeding America to follow the rules and regulations established by OMB, incur certain expenses in compliance with cost principles, obtain an annual audit in accordance with uniform guidance, submit a summary of research findings to USDA, and then any unused assets are forfeited, and any unallowed costs that have been drawn down must be refunded. Feeding America retains the rights to the research findings. I'll give you a little bit to kind of think through what those answers would be. Okay, so we'll kind of dive into the responses just in effort of time, but this would be considered a non-exchange transaction. Commensurate value is not being exchanged between the two parties. Feeding America is the one that retains all the rights and receives that primary benefit. The federal government's benefit is incidental because the findings that are coming out of the work is serving the general public. We are considering this to be a conditional contribution. It has both that barrier and the right of return. So there's discretion in there as far as how the assets may be spent. They have to follow cost principles. There's that right of return. Again, kind of going back to what Stacy was communicating, that audit requirement alone is not considered a barrier because it's not related to the purpose of the agreement. And in this particular case, this is a restricted contribution because the food insecurity in rural areas is more narrow and focused than Feeding America's overall mission. Okay, another example. This is a grant from a corporate foundation. Healthy Foods for Us studies vegetarian health concerns as a small part of its overall mission. It applies for and receives a $100,000 grant from Eat Veggies of America to perform research on vegetarian foods. The grant includes the following stipulations. There's a right of return on any unspent funds, and there must be prior approval for any significant deviations in spending from the budget that was part of the grant application. There's also a requirement at the end of the grant to provide a budget to actual report and explanations as far as any deviations from the budget line items. So same thing here. Are we looking at exchange versus non-exchange, conditional versus unconditional, and is it restricted versus unrestricted? So in this particular example, it is considered a non-exchange. Eat Veggies of America could receive, an incidental benefit based on the research, but again, it's kind of the general public that's receiving that benefit. There's no commensurate or no equal exchange of value between the resource provider and the recipient. This is an unconditional contribution. We had that right of return that was included as part of the agreement, but no barrier to overcome. As we talked about, those administrative type items like a budget or looking at that budget to actual reporting and things like that are not related to the purpose of the agreement and not meeting the requirements of being a barrier. This would fall under being a restricted contribution. Again, that the studies on vegetarian health concerns are more narrow in focus than the overall mission. Third example, We Love Veterans receives a grant from a private foundation for funding for $500,000 to provide specific career training to disabled veterans. The grant requires the nonprofit to provide training to at least 8,000 disabled veterans during the next year, and there's specific minimum targets that must be met each quarter. There's a right of release from the obligation in the event the nonprofit fails to meet the targets in any given quarter. So again, we have those same categories of what we think this would fall into. And this would be considered a non-exchange transaction. The nonprofit is not receiving direct commensurate value in return. It's considered a contribution. There has to be that equal part or equal exchange or equal value to both parties. This would be considered conditional. There's both that right of return in addition to the barrier that exists. There's specified levels of service that they have to provide. Again, that audit requirement alone is not a barrier, is it's not related to the purpose of the agreement. And kind of going back to the exchange versus non-exchange, if there was kind of back to some of those criteria of how you would get to each category, if there's an expressed intent by both the recipient and the resource provider to exchange goods or services that are of direct commensurate value, it would be an exchange transaction. So again, if there's that expressed intent there that you think these are of equal exchange, it would fall under being an exchange transaction. Okay, I am going to hand it over to Stacy.
All right, so we have a couple more examples here. Lots of examples. We're hoping that will just help to solidify in your instance what the answers might be for some of these. First example here, we have Best School Academy receives a multi-year pledge from an alumnus to build a new state-of-the-art campus, which includes some space for a technology lab. The pledge amount is $20 million, payable over a 3-year period. So $7 million, the first $7 million is payable upfront on July 1st of year 1 and with no associated conditions. The second payment of $6 million is entitled and payable on the second year, July 1 of the second year, upon evidence that the land has been cleared, that has some architectural design has been received, and the proper building permits have been obtained. And then the third payment of $7 million will be payable upon receipt of the certificate of occupancy for the building. So as we look at this example, this would actually be considered non-exchange because again, the individual is not receiving commensurate value for the $20 million transferred, but we have both conditional and unconditional. So that first $7 million would be considered to be unconditional because there's no additional conditions they need to meet. But then the remaining $13 million, unless it overcomes those respective barriers, would not be received. So the individual did retain a right of return on the $13 million should the barriers not be met. As we talked about, the likelihood of meeting those barriers is not a consideration under the new guidance when assessing whether it is conditional or unconditional. And in this case, it would be considered restriction because construction of that building would be more narrow than BSA's overall mission. Our last example under this category is a financial aid grant for tuition. So we have a student who's enrolled to attend the University of Accounting because they have a passion for debits and credits. I mean, who wouldn't? Come on, it's good stuff. The student's tuition for the semester is actually $30,000, and the student received a Pell Grant in the amount of $2,000 to use towards their tuition, which is going to be paid directly by the grantor to the university. So as we look at this, we do have an exchange transaction, and that transaction is between the student and the university. So the university is going to account for that grant, though, as a third-party payment on behalf of that student to an existing exchange transaction. So that contract is with the student and the university. The grant was awarded to the student, not the university. We talked about the university as the exchange transaction with the student, and really the $2,000 grant is a partial payment of that original $30,000 exchange transaction. So it's not additional revenue. The student is an identified customer to the university, and it's the student who is receiving that benefit and not the grantor. So as we look now, we've looked at some examples. How is this to be applied? This is actually under current GAAP, there's this simultaneous release option. So under legacy GAAP, it allows for the non-for-profit to recognize a restricted contribution directly into or unrestricted or net assets without restrictions if that restriction is met in the same period that the revenue is recognized. So if you can make that election, but if you make that election, it's all or nothing. So that's going to apply to all of your donor restricted contributions. So under the new clarified guidance, there's actually two buckets. So you can make an election for all your restricted funds that were initially classified as conditional without having to treat all of your restricted contributions as grants in that same way. So an example where we see this being used is your governmental grants. So you have to incur those qualifying expenses. And as such, at that time you are incurring those qualifying expenses, you are both meeting that condition and restriction is being satisfied at the same time. So you can make an election to treat all of your revenues that were initially classified as conditional as being shown as your net assets or your revenues without donor restrictions column or category. So that's nice that you can make it for just that one category and not all of your restricted revenues if you choose. So transition guidance. You're going to look at your agreements at the effective date, and you're going to determine if you have any agreements for which were not fully completed or the revenue was not fully recognized at that point in time, and you're going to apply the remaining portion of those agreements or grants under the new guidance, clarified guidance. And also you apply it to any new agreements that you receive after that effective date. So there's no prior period restatement, no cumulative effect adjustment to your opening assets. You can apply a retrospective application. We think this is fairly uncommon when this method would be used, however. So let's look at a couple examples of this. So for modified prospective transition, our first example, we have a nonprofit that's implementing the new standard, clarified standard for calendar year 19. They had a 3-year grant that was awarded on 1/1 of 18, and the payments were $150,000 per year for 18, 19, and 20. So prior to adoption of this new standard, the nonprofit treated the grant as unconditional contribution, and therefore, in the first year, all of that revenue was recognized on 1/1 of 18. So after, or in the year of implementation and going forward, the grant is already a completed agreement because they've recognized all that revenue. And so no changes will be made to that revenue that was previously recognized. In 2019 and 2020, you will continue releasing those net assets from their restrictions. Our next example here, similarly, the nonprofit's implementing that for calendar year 19. In this instance, it's a 5-year grant that was awarded in 18, and payments are $75,000 per year. So accounting prior to the ASU, the nonprofit treated this as an exchange transaction based on the information they had. So revenue was recognized as it was billed. So in that first year, they recognized $75,000 of revenue. So we're looking now in the year of implementation. We realize we don't have a completed contract. There's still some more revenue to be recognized. And in further determination, after looking through the agreement, the nonprofit determines that there actually is a right of release and a barrier. So they're determining that it is a conditional contribution. So the remaining years, 2019 through 2020, they're going to recognize that remaining revenue as those conditions are met. And one final example under this transition perspective, we have the ASU is being implemented again, same time frame. It's a 3-year grant. It's $100,000 per year. So prior to our implementation, the nonprofit had accounted for this as a conditional promise. So revenue was being recognized as the conditions were met. So they had recognized $100,000 through the end of 18. So as we're looking now in the year of implementations, again, it's not a completed contract or completed agreement. We still have some more revenue to recognize. And in looking through the documentation, they determined that it actually is unconditional. Maybe they were looking at a probability assessment before, and that has gone away. So now they realize that it's really unconditional and should be recognized. So in 2019, they're going to recognize the remaining $200,000 of that 3-year award. And then in 19 and 20, they will release those restrictions as the restrictions are met. So those give you a couple of examples of how that would be treated based on some of the different circumstances that you might have. So next, we're going to look at disclosures. And there's good news here. The clarified standard does not change your existing disclosure requirements. So very rare that we have that. We're not adding more to what we need to do. However, you may need to add some additional disclosures if you have conditional contributions that were previously maybe treated as exchange transactions. And under the guidance for what you need to disclose for those conditional promises, you need to disclose both the total of the amounts promised and the description and amount for each group of promises. So you might look at all of those conditional items and group them together. Maybe you have a group of items that are subject to matching, or in the instance of your federal awards, you need to incur qualifying expenses. You can group those together in categories and disclose them as such that way. So it's not intended to be a laundry list disclosure where you're including every single individual condition. You can put them together in groups and report on them that way. So with that, we have our second polling question.
All right, the second polling question is true or false.
Awesome. So for this ASU, you may need to add additional disclosures for conditional contributions for transactions that were previously treated as exchange transactions. And the answer is true. So great job. Pam is now going to walk us through the revenue recognition under 2014-09.
Okay, ASU 2014-09. So this is revenue recognition. As I explained earlier, this standard covers all industries, not just nonprofit industries, and really focuses on revenue earned from contracts with customers. So as we kind of went through some examples previously, we talked about, okay, do we have exchange versus contribution? When we say it's an exchange transaction, again, it's a reciprocal in nature type of transaction, value for value. I think the most important thing to look at is both of these standards really do have to be evaluated when you're looking at your revenue streams. And the first things first, you go through that first question of whether or not it's a contribution or exchange transaction. If it's exchange, this is the guidance that you'll follow. So as I mentioned, this is covering contracts with customers. So as you can see on the slide, there's certain contracts with customers that are excluded because there's separate guidance for these particular items. So those first 5 bullet points there, as we know, there's separate lease guidance, and same with the following items. And then we go down to certain contracts that this standard is not including as being customers, which would be contributions included in that. So again, you would follow the previous guidance we talked about, which was ASU 2018-08. So as part of this standard, they did define in the standard what is a contract. A contract is considered an agreement between 2 or more parties that creates enforceable rights and obligations. A contract doesn't exist if each party to the contract has a unilateral enforceable right to terminate on an unperformed contract without compensating the other party. So that would not meet the requirements of a contract. Contract can be written, oral, implied by customary business practices. Kind of an example of that is I go to a museum, I buy a book from the gift shop. Obviously, there's no written contract in that purchase, in that transaction, but because of customary business practices, it's considered to be a contract with a customer. So just some further clarity on contracts with the customer. Again, straight from the standard about what is considered to be a contract. The parties to the contract have both approved the contract and are committed to performing their obligations. The entity can identify each of the parties' rights, can identify the payment terms. The contract has commercial substance, and based on the terms of the agreement, it is probable that the entity will collect substantially all of the consideration that's outlined in the contract for that exchange of goods or services. So ultimately, will the parties carry out their terms of the agreement? So the standard has really kind of taken a core principle and tried to boil it down to get to how we recognize revenue. So the whole purpose of the standard is to recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled to. So we talk about performance obligations as part of this, and what we mean by a performance obligation is that's that promise to transfer those distinct goods or services as part of that contract. So the standard has boiled this down in the application into 5 steps that you should be following in this recognition process. So first step being identifying the contract with the customer and making sure you have a contract, which we previously talked about. The second step would be identifying the performance obligations. Again, this is that promise to transfer distinct goods or services. So a couple things to point out here. A performance obligation is capable of being distinct. That customer can benefit from that good or service. And it has to be separately identifiable within the context of the contract. So keeping in mind that there could be more than one performance obligation within the contract. Next step would be to determine the transaction price. And then the fourth step would be allocating the transaction price. Now this gets a little more complicated when you have more than one performance obligation as part of that contract. And then the last step is, which is probably the most important step, is to determine whether you recognize that revenue when the performance obligation is satisfied or as the performance obligation is satisfied. So looking at this is, you either recognize at a point in time or over a period of time. So a point in time example would be my previous example about me going to the museum gift shop and purchasing a book. That is an instantaneous purchase transaction. You'd recognize that as that happens, or at the point in time where that happens. An example of where you'd recognize revenue over a period of time would be childcare services. I have paid my monthly fee for childcare services. You'd recognize that revenue ratably over that contract period, whether it's a month, 2 months, 1 year. So again, more examples to boil this down. A not-for-profit membership organization has annual membership dues of $300. The only direct benefit members received is a monthly newsletter with a fair value of $50. So going through the 5-step process, so identifying the contract with the customer, the only piece that is really that exchange between the nonprofit and the customer is that $50 for the newsletter. The remainder is considered a contribution. Second step is identifying the performance obligation. So the nonprofit has an obligation to provide that monthly newsletter over that membership period, which is a year, to the member. Next step is determining the transaction price, which is the fair value of the newsletter, which is $50. And then allocating the purchase price. The $50 is allocated to the performance obligation. And then the last step is recognizing the revenue when or as the performance is satisfied. And in this example, the nonprofit has an obligation to provide that monthly membership newsletter throughout the membership period, which is 12 months. So that $50 would be recognized ratably over that 12-month period. And then the $250 contribution would be recognized upon receipt. The next example, a little bit more complicated, student tuition and fees. So a student applies to a university paying a non-refundable application fee of $300. After being accepted, the student attends orientation held in the spring, paying $800 to attend. The student registers for the fall semester and gets a tuition statement as follows. The student may withdraw without penalty within the first 2 weeks of the semester. Policy doesn't apply to books and activities. So taking this down through the 5-step process, so identifying the contract with the customer, we have a completed contract for the new student orientation. There's an executory contract for tuition, activity fees, and application fees. Thing to point out here is that application fee, kind of going down to number 2 and identifying the performance obligation. That application fee doesn't actually give rise to a performance obligation. It's in essence an advance payment to be recognized as essentially tuition revenue over that semester. The school doesn't have to do anything in return of getting that application fee. So the other performance obligations that we have are providing classes to the student for the semester, providing student activities, and then access to books and lab supplies. So then you can see how we break out the transaction price, $300 for the application fee, $10,000 tuition, and then the books and lab supplies are $750, student activities are $250. So allocating the transaction price. As I mentioned before, that $300 application fee rolls into the tuition costs of providing classes. So that's the $10,300. $750 gets assigned to providing books and lab supplies, and then $250 to provide student activities. So then the revenue recognition process in number 5. That tuition period stretches over that semester. So the tuition, the application fee, and the student activity fee gets recognized ratably over that semester period. And then the $750 for books and lab supplies, that's when the time of purchase happens, that gets recognized as revenue. So you don't have to stretch that over the semester period. So unlike 2018-08, there's a little bit of disclosure requirement associated with this standard. So you can see those items there. Some of these items can be satisfied on the face of the statement of activities or within the notes to the financial statement. Going to go through our next polling question.
All right, here the third polling question is another true or false.
All right, the answer is true. A contract is an agreement between 2 or more parties that creates enforceable rights and obligations. More reporting and disclosure requirements. These are the requirements for public entities. I won't go into the details of those. Just know that if you're public or have public conduit debt, there's extra stuff you have to disclose. So as far as transition goes, there's 2 options that you can select here. Full retrospective approach, where you would restate each period that is presented in the financial statements, or you can go with the modified retrospective approach, which is a cumulative effect in the initial year of application. If that is selected, there's an extra disclosure that's required there as well. Okay, with that, I'm going to hand it over to Stacy.
All right, so the stuff you've all been waiting for, how to implement these standards, what process, where do you start, what do you need to do? So the first step that we have identified kind of in trainings that we've gone to and in discussions we've had with clients, you're going to want to review your current practices. So what policies do you currently have in place? If you have a gift acceptance policy, do you need to revise that policy to kind of incorporate some of this information, some of those terms, maybe about barriers and right of release? Do you have to make any changes to your accounting procedures when you are doing your reconciliations, or when you are posting those entries to record your revenue? You're going to want to update each of those as necessary. And then the next thing you're going to want to think about is engaging others. Who else should you be involving in this process? If you have a separate development department, should you be pulling them in so that they're aware of these changes and the communications that they're having with donors? Your relations maybe with foundations. If you are receiving a number of grants from foundations, do you need to look at those agreements? And do they have wording such that is causing those agreements to be conditional, where the intent of the foundation is not that they actually be conditional? Do you need to work with them to change the wording? And then getting some training. So attending this webcast today is a first great step, just learning about the changes and how that's going to impact processes in your other departments potentially. You could look at developing practice aids. This could be a checklist or a decision tree maybe that you're putting together to answer some of those questions. And then also you need to consider the system capabilities. Are there limitations within your current system? Or maybe your system is not capturing all the information that you need in order to make those determinations. So you need to consider that as well. We have put together kind of the steps, or broken down the implementation into steps. So the very first thing you're going to want to do is you're going to identify all your revenue streams. So Pam kind of alluded to that before. Every revenue stream that you have, whether it's exchange or non-exchange, the first step is going to be listing them all out. And you will want to take materiality into consideration. So, if you have an immaterial revenue stream, you're not necessarily going to need to go through this process. But the first step is to identify those revenue streams, and then you're going to determine if you have commensurate value. So are you getting, is there exchange of value for value? Is it reciprocal? If yes, you're going to follow that revenue recognition guidance. So that's the 2019-04. If not, you're going to apply this contribution guidance, this first part of the presentation that we had today. After you have gone through step 1, our next step then, step 2, if you have contribution guidance, are there conditions present? Are there those barriers and right of return? If the answer is yes, you have a conditional, so you're going to wait to recognize your revenue when those conditions are met. If no, it's unconditional, but then you need to look, do you have restrictions? Are you going to be recording that as revenue without donor restrictions or revenue with donor restrictions? So you're going to need to analyze your open agreements for potential impact. And as I mentioned, you may want to put things into buckets. So maybe you can determine that all of your federal grants need to incur qualifying expenses. So that's going to be one bucket. Maybe you have several grants or revenue sources that are your primary sponsor is the same. Maybe you have state grants, and so those are worded similarly, and those can be another bucket. You're going to, again, make sure you're considering materiality in that determination. Finally then, step 3, our favorite term, document, document, document. So as auditors, we will be looking to you to see what analysis you have done to come to the conclusions of how and when that revenue is to be recognized. So you're going to want to document your process, any assumptions you make, and the conclusions you come to. So for example, if you get clarification from a granting agency on something within their agreement, you're going to want to retain that as support in how you came to your conclusion. You're going to need to update those policies and procedures as needed. That can be done at any point in time. It may need to be discussed at your board level if you're changing a specific policy or resolution. And then thirdly, just reviewing your approach with your auditors. So as you'll reach out during this process if you have questions or unique circumstances. We tried to give you lots of examples, but as we know, we can't get to all of those examples, so there will be some differences. So with that, we have our final polling question.
All right, the final polling question here. So as we're wrapping up here, if you do have any more questions, please use the Q&A box to submit those and we will get those answered offline.
All right, so how many steps are listed in the implementation process? And the correct answer is 3 steps. We will thank you for your time today, and if you have questions, please submit them and we will get answers back to you.
Awesome. Thank you guys so much. And if you do have any other questions, you feel free to reach out to Pam and Stacy directly. Hopefully everything went well with this recording. We will get that sent out to you within a week. Thank you to Pam and Stacy, and everyone have a good day.